I don't see a green dot.
There you go. Now we're on.
Okay, please proceed.
Thank you, Mr. Chairman. So reiterate from this morning's comments, the number one point that we were making is this would not be a surrogate for the constitutional amendment that we talked about. That is the number one issue that would change the way we can do the management because of the definition of our earnings. But if we can't do that in the near term or as a segue into something like that, the other things that we could potentially do would be to increase the returns of the funds by reducing the total funds, the pools that we have, and to put them into a larger fund that would have the same asset allocation as the PMTF. The second part of it is the accounting and distribution side, not only accounting and distribution, accounting from the investment side, but how we do our quarterly balances and all the other issues when we transfer funds is extremely cumbersome because of the 15 funds that we have, but also from the accounting side, that if we could simplify that process as well. And Katie will be following up with me and go through some of those issues that would be alleviated and how much it would make what we do in a more simplistic way. And those are the two facets of what we're looking at. From the investment side, we can quantify the numbers because we know what would happen, what would have happened if we were able to put those funds together. And we said that if we put the funds into the total of 15 odd billion to have one fund that had the same return as the PMTF, then we would have earned an additional 370 million. And if we were able to roll the two PMTF and common school reserve accounts into that same fund, that would add another 141.5 million for approximately $510 million in additional revenue to the state if we were able to do this. Mr. Chairman, is that over the last 5
Go ahead,
years?
please.
Thank you, Mr. Chairman Patrick. So I want to make sure I'm clear. You talked about the constitutional amendment, and then you says, but if we can't do that, then we go to what you explained to us on the reserve accounts. But I thought that even with the reserve accounts, the constitutional amendment would help you in administrating an increased reserve account, would it not?
Mr.
Or do
Chairman,
you not need the reserve account then?
Mr. Chairman, Representative, you are correct. We would not need a reserve account if we changed the definition of income, because it would just be the total amount of money that we had. It would be regardless of the breakdown between interest income, dividends, realized and unrealized capital gains. Now, in previous sessions, we talked about, would you want to walk before running and still keep a reserve account just in the near term? But no, you are correct. If we were able to change that definition, we would not need a reserve account.
Which we tried to do,
Representative Harshman.
Thank you, Mr.
as I
Chairman.
recall.
Sorry. Thank you, Mr. Chairman. Okay, on the, talking with Mr. Richards, you know, and you mentioned earlier, 20 years ago, we just had a few accounts, and now there's like 15 accounts.
That is correct.
Now, it's my understanding that those are not creations of the legislature. Those are SLIB board creations. So they could be uncreated, you know, next week, is my understanding. Is that?
Mr.
ahead.
Chairman, Representative, well, let's just look at this year. We had additions. We had DEQ. We had the ARPA funds, and we had the Tomorrow Fund. So those were three additions. I would say those were legislatively mandated. Now, the ARPA fund was just a short term, so that one would be very different. But the other two would have been, I believe, legislatively, not SLIB board mandated.
Okay, so we'll get some more clarity on that as the day goes on, but I don't know. There's a few of them certainly are legislative, but I think we'll learn some more, I guess, as we keep going here. Thank you, Mr. Chairman.
One point on that, Mr. Chairman, Representative, is the SLIB board had changed the allocation. So for instance, the income focus, that was SLIB board mandated because they looked at how we needed that 5% spend and said, especially in the low rates, because at that time interest rates were plummeting. And they said, we're going to have a hard time coming up with 5% with this asset allocation. And so they looked through it, and I am not saying that their decision was wrong. I would definitely say that at that time, the decision was right to do what they did because, as you know, interest rates were zero. How are we going to come up with a 5% spend at that time?
What particular account are you referring to from the?
The Common School, Mr. Chairman.
And so do we know if SLIB is intending to revisit the asset allocation now that interest rates are no longer zero?
Mr. Chairman, the chair of the SLIB and the governor and the treasurer have talked about this, and we actually looked at it and they had requested that the IFC look at our allocation to see whether or not that should be changed. And it came back to the bottom line on it is still, if we had a big sell-off, so Common School, let me take a step back. When we talked about the risk, remember I said that our risk allocation is a 22% loss at the 99% confidence interval. That's a Monte Carlo simulation that you do. Common School is at a 20% loss at a 99% confidence interval. So it's only 2% difference. In that instance, if we had a big sell-off like we've had in umpteen numerous years, especially with the probability of a recession going higher, the probability of a recession, then you would have an issue with that spending policy with the current reserve accounts. So even though now interest rates are higher, if we go into a recession and the typical fashion is equity sell-off, bonds rally, rates would come back down again. And that would put us back into where we were a few years ago. So without a higher reserve account, it's problematic to roll that reserve account into the same fund without having more years of cushion in a negative return environment.
Yep.
Go ahead.
If you don't mind, Treasurer Meyer, maybe this question is to you. As I've listened to this, what is your preference as the treasurer? If you had to pick between the two, would you do the constitutional amendments or would you do the increased reserve account? Or both?
I think right now, the increased reserve account is probably the quickest way to get to where we want to go. I do want to proceed with a constitutional amendment that has enough sideboards on it that we don't have to worry about what happened to Alaska that could happen to Wyoming. And when I say that, to further explain, Alaska, they got in kind of a bidding war between the legislature and the governor about how many dollars they were going to go out and buy votes with, I think. And so they spent, I think, close to $13 billion in one session when they probably should have spent about $3 billion in one session. So, yeah, we have to have I think, a certainty, whether it's in this situation where we've got larger reserves or whether we go into a constitutional amendment. We have to have a certainty about how much is actually going to be spent, and so that we know that we can have that stable, adequate funding in these areas that require, as I say again, certainty. Now, I think that one thing that's changed probably since the time period, well, it definitely has changed since the time period that years ago when we had this differentiation into a fixed income, or into an income approach, is the reference portfolio that you guys put out there. Because now we have a lot more diversity and we have a better chance, even in zero interest rate environments, of generating income because of that diversity. So I think there's a lot of things that have moved forward and made this lift easier. So, I think that the first thing to do is probably to move into the PMTF and the common school. That is, as has been noted, is where the low-hanging fruit is, and to make sure that we have the same investments of our reserve funds, but realizing that there is an added amount of risk there, and we have to really price that out. So you guys know exactly what that is. And then the implementation on this is not going to be snap your fingers and it's done. So we'll go through the same type of implementation and a checklist, just as we did when we onboarded our accounting system. So we know everything that's going to has to be done, and we've looked at everything, and we went through the legal aspects of it and the accounting aspects of it, and actually ran the risk analysis on all of it. So you guys have, I guess, everything that you need to make a decision as to move forward and how fast we move forward. So, that's, I think that I don't want to leave another 50, 60, $70 million on the table when it's not going to be an easy lift, but there's a way to get from where we're at to actually having I think a lot more consistent return. And if you look at it as we go through this process, the extra money that we make, if we have the fortitude to actually put that back into the corpuses of these, then you'll be growing that revenue stream, and that's I think the goal of all of us is stable, adequate funding and a growing revenue stream.
Okay, further questions? Please proceed. Go ahead. All right.
Mr. Chairman, as we spoke about this morning, is to look at some of the other pools and how they would be impacted. And in the subcommittee, Senator Hicks had asked if we put together and actually look at the percentages of the various funds and where they're housed. So in these slides, you will see percentages of where they are so you can understand. So the first one that I'm going to address is Pool A, and I believe that's slide 10. So Pool A, this was the original tobacco settlement fund that then morphed into taking the accounts in the state agency pool that had excess cash needs and had the ability to invest in a longer term investment to increase their returns. So this was put into Pool A. And just to clarify, one thing when I spoke about common school, I believe common school is 22 as well and not 20% on that risk, because Pool A is a 20% risk on a 99% confidence. But I'd have to check those numbers, but I believe I misspoke when I said 20 for common school. I think it's the same. Anyway, Pool A has very similar characteristics of what their needs are. This should be cash that these various funds have that are not needed. What they need is the income generated from the cash, which would then define kind of what we're trying to do. So if we did do this process, what would happen with Pool A? Well, it would go into the total return fund. And in that instance, then these funds that would be in it, let's say Game and Fish or Natural Wildlife Resource Trust, those are the types of funds that we're referring to. Then what I would suggest is they would look at it, and they already have a cash account in the state agency pool. They could then dictate saying, well, how much do we need in a total return fund and how much do we need in cash? So for me, this would be a natural fund that would then go into this type of a allocation. But these are things that we could discuss later or what have you. But I just want to run through the ones that are not so clean and neat and easy to where they would go. The next one, workers' compensation. Workers' comp, as you know, the main focus of the workers' comp is not return, but looking to offset or tenor match their liabilities. So they have a duration of their liabilities of around 12 years. So that is where we have assets that match off that liability. Any excess return above the funded portion Then we kicked into this additional fund to try and get a higher return. So this would be one that we'd have to discuss with workers' compensation, because as you can see on page 11, that core fixed income has 26%, long duration has 23%. So there is your basically 50% of the fund is offsetting that liability. And then the other 50% would be in a higher yielding total rate of return fund. So that would be the premise on workers' comp and why they cannot fit into a total rate of return because of their structure. Another fund that would not fit in is the LISRA. So as you know, legislatively mandated, the first 500 million in the LISRA is put into a very liquid cash account, basically. So it's the low duration fund. So this is, as you know, the rainy day fund, so it has to be liquid. So now the big question that I have for you is, we have the 3 tiers. The next one would be core fixed income. That's another one, very liquid. I can access the funds in 2 days, no problem there. Should have a little bit higher yield and would also fulfill that requirement. The third leg, that's the one that we put into higher yielding assets. If we did put that third leg into a total return fund, there is illiquid instruments in that structure. As I mentioned this morning in the PMTF, when we're talking about real estate, we're looking at private equity. That would be something that you would need to discuss and saying, if it was a Cat 5 hurricane and we needed the total fund, you would not be able to get the access to those funds in a short order. So that would be something that you would have to discuss. Does this make sense to have that third leg in the total return structure? The next one that I want to discuss is the state agency pool. So this one has been discussed many times, and as you see in the upper right box, the market value as of May 22 is 5.3 billion. And we talked about it before, it has yielded 1.5%. You look at it and go, oh my gosh, how, this is ridiculous. We have $5 billion earning that. What can we do? The one thing that I want to reiterate and make sure everyone understands, and Katie is going to speak about this and clarify it for you to kind of walk through where that money is this is like your checking account. So these are funds that are needed on day-to-day operations. Just like your checking account, you're not going to go out and buy stocks in your checking account. This is what you need to pay your utility bills and your grocery bills and things like that. So looking at it to say, oh, we could put it into these different funds and we could get higher yields or whatever, that is problematic, because the number one factor on this fund is not return, but safety of principal. Because if you remember years ago, they did put in all kinds of this stuff in there. And when we had a loss, the cash balances went negative. There is not a reserve account, so you can't have a negative cash balance. So we had to do this. So all of us met till 9 o'clock at night one time, went through all the different funds. How do we get through this? And what we did is we put together a ladder strategy that we manage internally to make sure that all of those securities that we buy, we will mature them and we will never have a loss. That was a structure that we put through. And if you see the lower amount, it's $3.8 billion that is in the ladder. So just so you know what a ladder is, we went out 4 years. So you buy a 1-year security, you buy a 2-year security, you buy a 3-year and a 4-year, all US Treasuries. When the 1 year matures, you take it and you buy the 4th rung of the ladder. So just as an example, June 30, we had one of the rungs mature. It was an 1/8 coupon. That's 0.125%. That's what we were getting. We rolled it into that 4-year. We received 2.87%. So that's the structure that we're talking about. So this will be beneficial. But what I'm saying on this one is that the way and the funds that are involved in this one, this would be very difficult to really enhance the yield in a meaningful way, to put it into a longer duration fund. Your general fund is housed in the SAP. Do you want me to take those funds and put them into an asset that could lose 20%? You think you have X amount in your general fund, you wake up and you're down 20%. That's the point that we're looking at. Now, what could we do? one of the things we could do is we're buying US Treasuries right now. And if we manage the fund and to make sure that we do not have a loss, just a simple example is we could buy corporate bonds, investment grade corporate bonds. And this is just a simple example of what we could do. Right now, the 1 to 3 year corporate bond index is yielding 83 basis points above US Treasuries. So as an example, instead of buying that 4-year Treasury at 3%, let's say, we could buy a corporate bond at 3.8%. We could get additional yield by doing this and still take a low amount of risk by doing something enhancing the yield properties of this. So it's, we're talking about lower duration where you don't really get a big bang for your buck, but you can see in this example, just for instance, if we had corporate bonds instead of treasury bonds, and that additional 83 basis points would yield a total income of $32 million additional dollars. So that would be an example. And, if you're talking about 5 years or whatever, now we're back into the $150, $160 million range. So this would be one of the ways that we could increase the income of the SAP if we looked at other ways to manage it. So with that, I would like to pass it over to Katie to just talk about what is in the SAP so you understand the dynamics that we're faced with and not able to have an illiquid instrument in this sector. So with that, I'll pass it to Katie.
Good afternoon.
And Don.
Good afternoon, Mr. Chairman and members of the committee. My name is Katie Smith. I'm the Administrator of Financial Accounting for the State Treasurer's Office. And so I did a quick little dirty analysis of SAP, broke it down, and I'm going to illustrate some of those pieces to you in that next slide of this presentation, as soon as it pops up there. So to break this down, we took it at a moment in time. So on May 31st, SAP was holding $5.4 billion. That's about 366 funds, including the warrant clearing account. So you will notice a slight difference between my cash balance number and the market value that was illustrated on the prior slide. That has to do with market value and also items in transit. So anything clearing the bank and things like that, timing. Essentially timing is what that is. Of that, 29 funds actually make up 80% of SAP, which is roughly about 4.3 billion. And those funds include the general fund, that includes the 2 reserve accounts that were spoke about earlier this morning, and also includes COVID dollars. So a lot of that balance is tied up in those funds. The remaining 336 funds is only just under $1 billion. I say only, but it's a lot of money, but roughly just under $1 billion. 57 of those 336 funds have a balance higher than 5 million. So this is just illustrating those components of SAP of where all that money is sitting.
Okay, go ahead.
So, Mr. Chairman, as you can see on that, these funds, you need these balances or the ability to do something with this. And the reason that we're spending so much time on this is numerous legislators are saying, you've got $5.2 billion, we got to get a better return. So I just want to make sure everyone understands where this money is and what kind of liquidity needs for these funds to be able to do so. The last slide that I have before we're going to pass it over to Katie to talk about some of the other operational and distribution efficiencies that could be had from this structure would just be WowStar 1, WowStar 2. These are just highlighting the Q. DEQ, this was the fund that was put forth. We don't have a balance on that one. The Arpa Fund, which is a temporary pool. That one was another fund that we manage internally. And just for instance, instead of just highlighting some of the things that we can do by having the ability to manage these funds internally, what we did is we worked with Don Richards and Kevin Hibbard. And what we did is we looked at what are the balances of what you need to spend And all we did is just, what every corporation would do in the world, they look at their liabilities and their management and their assets, and they just match them off. So what we did is we said, okay, you need $50 million in September of 22. So then we go out and buy a $50 million T-note that matured before September. By doing that, instead of investing in cash, we are going to have an additional $18.5 million in this Arpa fund, this last $500 million that came through. So these are just things that we actively manage the cash balances of the fund to try and maximize returns. So in closing, before we pass it over to Katie from the investment side, as I said, this is just a thought of some of the things that we potentially could do to enhance the returns, and look forward to potentially working with you to further this process if you see fit. And with that, if there's not any questions, I can pass over to Katie for the last 2 slides to talk about some of the operational inefficiencies that we could alleviate.
Go ahead. What's an overview?
Thank you, Mr. Chairman. Just a thought to throw into the arena of ideas on looking at constitutional solutions to some of these issues. One of the analysis that was done by the investors in terms of more of an endowment model, in that in the scenario they drew up, they talked about being able to sell bad stocks, dogs, I think they referred to them, and being able to distribute the principal amount so that in that limited sense, it would be invading the corpus. So I guess what I'm trying to explore is, are there some limited things we could do at a constitutional level? For example, like allow that type of transaction to actually sell and distribute assets deemed to be troubled assets that need to be discarded.
Mr. Chairman, Representative Obermuller, I have not heard of that, but just the first thought I was thinking of is the time that this would occur is in a down market. So you're going to see many things that you have that you own will be at a loss. And in that instance, the pure definition constitutionally, I would say, is whether you're selling a good asset or a bad asset. If you are dipping into corpus, that would still be prohibitive. So I don't, just first glance, I'll have to think of it more, but one, how do you define the dog versus a semi-dog or quasi-dog? I don't know how you would do that. And 2, if you are dipping into corpus, that I believe the lawyers of the group could tell us whether that would be the definition of invading the corpus, but I still think that would be disallowed.
Mr. Chairman, I guess that's the point I'm getting to, is the constitutional amendment would allow the managers to dispose of and distribute what they determine to be.
Mr. Chairman, Representative Oldham, I misunderstood your question. Yes, if we could do, if the funds were not inviolate, like New Mexico, then we could do whatever we want on that, and all of this other part is irrelevant. So if you could get a constitutional amendment to allow the spending of the corpus, then that would completely change the game. But
yeah, Mr. Chairman, I guess I'm trying to limit it to spending the corpus on assets deemed to be disposable, needing to be disposed of based on an analysis of the, just narrowing it to that type of asset that needs to be dropped and sold and distributed. Just
Mr. Chairman, Representative, yeah, I mean, our portfolio is such high quality. When we have, so for instance, our investment grade portfolio, corporate bonds, BBB- is the delineation. As soon as they drop out of BBB-, we sell them. Our managers have 3 months to get rid of them unless we have a shorter one. We don't keep garbage in our portfolio. Something that's.
Yeah. Mr. Chairman, what was in the analysis that was done by the analysis group or the investment group was having the ability to actually sell something and distribute the principal part of that as part of their fulfilling the spending policy amount, I guess is where they were going with that. Anyway,
Very
just
interesting,
something-
very interesting topic. I'd have to do much more research on it to see whether in a normal downturn, how many really dogs you would have and whether that would be sufficient to fulfill some of the needs.
Right.
I don't know that, but I can look into it.
Thank you.
Interesting concept.
Thank you, Mr.
Yeah,
Chairman.
Mr. Chairman, I think what Representative Obermueller was talking about was the definition of a reserve, and you could sell that if it was over the value of the corpus. And so that was the context, I believe, that demonstration was put forth.
Go ahead.
That was part of that analysis. I mean, if you go back and look at that, that was within the context of the value of the fund being in excess of the cost of that fund, that you could sell a particular asset that was not performing, in fact, was in a loss position. You could sell it, distribute.
Yeah.
The,
And that was the definition within the context of the constitutional amendment was defined as such that the reserve was not part of the corpus, and you could sell everything, realize on the underlying value of it. That
Yes.
could all be basically put into the revenue stream.
Yeah,
And-
Mr.
and
Chairman,
that-
yes,
I
yeah, that's
believe
good.
that the
that you
reserves
reminded me
would
of that, yeah.
act in this situation without a constitutional amendment, that you could sell anything that was part of the reserves in its entirety and take all of that revenue derived from that sale and use it as income.
Yeah, Mr. Chairman, thanks for that clarification. I think that's right.
Okay, Mr. Kuchar.
Thank you. And going back, and I want to make sure that I'm tracking. And Patrick, when we go back, and so like I'm on page 3. Go back to page 3, and you've got the highlighted in yellow, the ones that you're talking about doing this kind of consolidated total return fund with. And so as we do that, is the concept then that ultimately these are united, but everything's just proportional inside that fund? Is that the concept? Because where I'm going with this is, at the end of the day, the Hathaway's looking for a certain amount of distributions. The higher ed, they're all looking for a certain amount of distributions to be made. I'm just wondering if when we do this, just trying to make sure that the beneficiaries or recipients of those distributions, when they were singular funds, are still going to be getting the distributions that the fund was set up for in the first place, even though that they've now been put in this total return.
Mr. Chairman, yes, that is something that would have to be done to make sure. Let's just pick a date, July 1 of 2025, whatever. At that point, you have your June 30 year-end numbers. You know the valuation. Let's just say these numbers on this side are correct, and the PMTF is approximately 10 billion, and the total fund is 15. So at that point, you would say the PMTF on the market value percentage is 2/3 of the total fund. So you mark it that day. This is the valuation that they have, and this is what they own at that point.
Yeah, so everything is just proportion. It's really becomes a very,
Absolutely.
very simple, you just allocate proportion to the total.
That is correct, Mr. Chairman.
But there's changes that occur when you have a distribution of the severance tax. And if each one of these funds will get a different percentage distribution at different times, and then you just use the planned sub-accounting formula and reset everything to that new proportion.
Right, I mean, I would assume that you would have some, Mr. Chairman, if I may.
Please.
I assume that you just have some date, and, that may be at the end of each quarter, it may be whatever it is, and so if there's distributions made out of some funds and not distributions made of other funds, then the proration formula changes because the value of that fund in relation to the total has changed. I think that's what you're saying, Mr.
Yeah, well,
Sure.
there's that, and it depends on whether you have the same standard of I guess, that we have today where there's two ways to do the plan sub-accounting. You can do it by the number of days that an amount of money has been put to work within a fund, or you can do it exactly by the underlying security. And so there's different ways to account for it, and we'll just have to look at the details of that. It's because, say you get $100 million in the PMTF and $50 million in the educational fund on the July 1, but no other fund got any other distribution, for another quarter. So, it would just probably be by the number of days that fund was invested, or you could do it by, I think that would be the easiest way in this case.
So, Mr. Chairman, and my main point is simply that the beneficiaries of the various funds, which would now be sub-accounts, they're still going to get everything that they're entitled to, plus potentially a little bit more because we can recover the lost opportunity cost.
That is correct.
Yeah.
And the end result, the question really is, what requirements does it take to initialize and to then to carry out those sub-accounts? Is that something that, say, if we bring bills, we pass this in February, that it goes into effect on July 1st of 2023, is that realistic? I mean, what has to happen to make this work?
I think the first thing you have to address is the reserve accounts, the asset allocations. I think SLIB has the power to do that now, but freeing up the reserve accounts so they're not in the SAP, I think that was a legislative directive.
My question is accounting-wise, what has to happen?
Accounting-wise, the first thing we have to do is figure out what the balances are on day one and how do we get to that. And so that's the very first step, and then move forward from there and put together one of those sheets like we did with the accounting system. And that'll probably involve some changes in the accounting system.
Well, it will have to. That's my question.
Yeah,
What has to be up and running in terms of your phase 1, phase 2, phase 3, and all of, your components that are going through now? At what point will your office, or could your office, be ready to do this?
So, Mr. Chairman, that's a great segue into the next two slides, because Katie is here just to talk about the things that would change and what she would need to do to be able to implement this.
And before we go there, I do have one more question.
Please.
So, Mr. Chairman, Pat, Kurt, I'm looking at this, and so at the end of the day, we kind of did this back of the envelope math on the reserve account, so we know how much you need for the total reserve account. At the end of the day, do we just have one reserve account that is? Do we just have one reserve account, or are we still maintaining individual reserve accounts for each fund that just then make up the total reserve account? Or it's just one reserve account, and then if you draw on the reserve account, then we figure out where that's allocated back to the individual sub-account. Does that make sense?
Yeah, absolutely, Mr. Chairman. One thing about this is just going back to your previous question, is when you have that percentage. So you would have that common school reserve account, that money that would go in. So if you would have that loss, you would still have to come up with those funds. You'd have to segregate that amount of how much you would have.
Right.
So,
but you wouldn't necessarily segregate it. I mean, you would just pay it out of the reserve fund, but then you'd have to be made whole through the income or the other, the non-reserve portion of the common school program fund.
that is correct, Chairman, Mr. Chairman, but also there are certain accounting about the amount of the common school funds have to be handled in a certain way, and distributions and so forth. So that would have to be into the analysis. Without going into that, I cannot answer that. But I don't believe that you could have one because of the difference. But I would have to look through the statutes and understand that better.
But if you had no difference, if the spending policy was 4% for everybody, pool A, PMTF, common school, then you could probably have just one reserve account, provided that everybody came to the table with the same amount of money proportionally to the total. And then you wouldn't have that type of accounting that you would have to have. It could all be flat and right across quarterly. Everybody gets 4% of that amount of income. So, but that's a heavy lift to get everything uniform. But that's probably the simplest way to do it. But you know, that's probably a discussion between you guys, and Katie can probably account. She'll figure out how to account for it, but I'm going to let her speak for herself.
Go
Mr.
ahead,
Chairman, Mr. Chairman.
Oh, go ahead, Mr. Vice President.
Yeah, a question. So on this distribution thing that we're talking about, and I guess the way I'm viewing this, and I don't know if it's, it doesn't look to me like you can actually establish a spending policy on this reserve account, that the distributions are just going to be whatever the distributions are, prorated based on percentage of contribution or ownership in that reserve account. I don't know how we would establish it unless it was otherwise. What happens if we have a 4% spending policy, we have a down year, recession, depression, whatever? So do we then invade the corpus at that point in time of the reserve account? And then how far can you go into those reserves? Is, I'm assuming it would be whatever prorated back to that, whatever percentage ownership is prorated into the corpus of that total reserve account. So I guess I'm asking a question, Patrick. It doesn't look to me like we can really establish a quote, aka spend us policy. The distributions will be whatever the distributions are based on that percentage of ownership. What am I missing?
Mr. Chairman, Senator, in just a couple clarifications. If you had the 4% spend, and we said that 2% we would get on the income coming in, so that 2% remaining portion, if you don't have the ability to pay that out in the normal fund because you have lower returns, then that additional 2% would come out of the reserve account. So there is no corpus that's being spent. It's the reserve account. Now, if your reserve account was depleted and you didn't have reserve accounts anymore because of a very long, protracted negative return environment, at that point, then you can no longer meet those spending requirements. All you're able to do without violating the corpus is the interest income, dividend, and realized gain. And if you're below your corpus value, then the Meyer rule kicks in and you don't even get the realized gain. All you would get would be interest income and dividend income until the corpus value got back to the beginning level.
So, Mr. Chairman, maybe a little clarification on my question. I'm talking, and so when I'm talking corpus, I'm saying, so if we roll all of these accounts into one, and we call that the total return account, I'm calling that the corpus. So it's not the corpus of the original PMPF. It's not the corpus of the Common School Permanent Land Fund. It's just the total return fund. And so my question is specific to that account. If we set this up, at that point in time, wouldn't distributions only be whatever those returns are? Can we artificially then set a spending policy on the total return account too? And I guess that's what I'm trying to ferret out, Patrick.
Mr. Chairman, Senator, so in that instance, just as the chairman mentioned, each one of the funds would still have a market value percentage or a valuation. So even though the total return fund is $15.4 billion at today's market value, the PMTF is still responsible for $9.5 billion. So even if you had that, even if you combined them all, each one of the separate funds still has to be accounted for its separate fund. We can't commingle all of it and just call it the total return fund and do away with whatever ownership would be. So in that instance, the corpus of the PMTF would still be known. The corpus of common school would still be known. You would never.
Yeah, Mr. Chairman, I understand that. What I'm really focused on is the return. So let's say the PMPF is 2/3 of the total return fund. The question I have there is the distributions back to all of those common schools, PMPF, general fund, whatever they are. I don't know how we could have set a spending policy on those. That's what I'm trying to struggle with Patrick, and maybe I'm just not framing the question right. I get it. It's all prorated based on the percentage of ownership of the quote total return account. What I'm wondering is the distributions out of the total return account based on a prorated amount can only be whatever those earnings are. They cannot be some arbitrary spending policy above and beyond what the earnings are out of that total return account based on your percentage ownership.
Mr. Chairman, Senator, that is correct. But if you use that example and just say $10 in earnings and $6.66 of that is attributed to the PMTF. So that amount, that's where you would look at it and say, okay, well, what is the spending policy? And if that 666 is sufficient for the spending policy, then it gets distributed and then you go through the tips. If it's not, then you have to rely on those reserve accounts, correct?
What reserve account? I thought it was all in the total return account.
No, sir. No, you would still have, each fund still has to have attributed its own reserve account. So
Okay.
The reserve accounts we're referring to, the fund would be 15.4 billion, but we're still going to have a PMTF reserve account. And so for instance, if you go to slide 3 and you see these boxes that we have in the yellow side, in this instance, we would add PMTF reserve account, common school reserve account. You would have additional funds that would be part of this big pool.
And that's the 5-year number, right?
I'm sorry, Mr. Chairman?
That pool, the size of it is you're saying a 5-year reserve, essentially.
Yeah, look at slide 7. That'll help you.
Yeah, in that instance, if we're saying 5 years, then you take the rolling 5-year average of the fund, which common school, as we know, is approximately $4 billion. And you just take, the 5% spend, which, 5 times the 4 billion is the 200 million. And we know we're getting approximately 80, no matter what. That leaves us 120 short.
Yeah.
And how do we come up with that? 120 times 5 years is 600 million. 120 times 7 is 840 million. You can pick your poison, whatever you want to do of how you'd want to fulfill this.
Profit, you mean?
And as Representative Harshman said, if you wanted to do the same thing in the PMTF, you wouldn't have to do the amount that we talked about before, because that is not the mandatory spend. It's, basically 3.5. So it wouldn't necessarily be the 787. It would be, basically half of that, 350, 390, 400 million.
So let's just, Mr. Vice President, that answer your question?
Yeah, it did.
Representative Overmiller.
Thank you, Mr. Chairman. So for me, some of this discussion rolls back to discussions we've had in the past. As part of this process of working through this, we're going to have to come up with working definitions of what corpus is. And to the extent that we roll these reserves into the bigger fund, and those they have a corpus component to them as they're invested. For definitional purposes, they cannot be considered corpus. So we're going to have to work on those definitions to make sure that everybody understands what is actually happening with that money, even though it's being invested.
Chairman, Representative, absolutely. No, those are not corpus. That is reserve account that can be spent.
income. Representative Harshman?
Mr. Chairman, just kind of circle back here on this deal, and I appreciate it. So really, first things first. I mean, we're going to do the easiest for the greater good, the greatest good. It's the common school account. Just simply increase the reserve account and invest that like the rest of the pool, really. I mean, that's the first easiest thing. And then after that, really, and then you correct me, I'm going to say this, probably pool A with that. And then if we wanted to increase the size of the permanent reserve account, so really the three biggies, common school, permanent reserve account, pool A, probably get all those three figured out and fixed. And then I still think, you go back before any of us were in the legislature, the budget reserve account was the LSRA. That's what it was created for. And then that kind of got moved in as the BRA/general fund. It's kind of that whole, and now we get the LSRA. And I think another dive down the road would be this whole, how big a reserve account, a liquid reserve account do we want? And we really haven't said that. We've had a lot of thoughts. We've had an LSRA up to 2 billion, gone back and forth. But anyway, the first things first to me would be common school account. That's where you're going to get the most money, 80% of the good. Is that correct?
Mr. Chairman, Representative, that is correct. By far, the biggest impact
Biggest deal.
is a common school, by far.
Easy. Be the easiest thing to do.
I
We're gonna
cannot
have a
comment on the
$1
easy
billion
side. I'll leave that to you.
We're going to have a surplus where we're going to have to save money, Mr. Chairman. And where are we going to save our money? And I think save it where you can grow it fastest is the way I look at it. But okay, thank you, Mr. Chairman.
Okay, any further questions? Katie, you're up, I think.
Thank you, Mr. Chairman. So the next slide is going to go over some of the accounting benefits that I see going to this new structure. But I want to say, if we go into I just want to be very cautious and considerate. If we go into a phased or partial type implementation, I can see that being somewhat problematic. Honestly, for us, I think it's going to be an all or nothing. And I know, Mr. Chairman, you were asking questions about, say this gets passed in this next session, is July 1st doable? And I feel like the structure that we have built with the accounting system is strong, and it's simplifying what we have now. It's the same type of pools, it's just less of them. And I think being able to transition that from June 30 to July 1st, definitely doing it at a fiscal year end is going to be the most advantageous. So just wanted to talk about that. I definitely think if we go to a partial or phased approach, I think we're going to actually perpetuate some of the complexities that we're seeing now. Even though we have this great accounting system and we're still working through it, it's still complicated. And this leads me into the first number one benefit. This aligns with best practices. That's the key to this. For us, we're constantly being called unique, quirky, customize. Everything has to be customized. I'm constantly training outside accounting firms, outside consultants, outside vendors on what we do, how we do it, why we have to do it that way. And so it eliminates all of those, what I call nasty words. They've become nasty in my time here. And so it brings us to a more cohesive, comparable and standardized type structure, so that I can, I don't have to worry about calling a CFO. This has actually happened to me, calling a CFO from another state and them laughing. Quite frankly, they laugh at me. They're like, wow, I get good looks. I get a lot of, well, let me know if you get that straightened out. That, we can maybe piggyback off of that. I don't really have a whole lot of industry professionals to talk to because we're unique. And so this really helps us leverage that, being able to talk to them about, industry, new GASBs that are coming out. How are those being implemented? You want to talk to your peers. And so this would help alleviate a lot of those struggles that I personally face, and I know a lot of my accountants do as well. The next slide goes over some additional benefits. to me, kind of no-brainers going to this structure. We have tried and have thought about for many years, honestly, going to a quarterly cadence. Right now, we're on a monthly cadence with distributions, reporting, all of those things, and it would be more advantageous to go to a quarterly cadence. Not only because it would save us time, but it would also allow the money to be sitting with the managers for a longer period of time. Obviously, the longer they have it, the better it is. And they're not having to sit on cash because we're drawing down every month to distribute earnings. So even though we've thought about this and have talked about this, and I have been brainstorming with everything else going on how we can do this, our structure is complex. And so going to a simplistic structure that is being proposed helps that become easier, honestly. Going to a quarterly cadence isn't as complicated when you propose this type of structure. Obviously, that gives us time efficiencies. Regardless of this monthly to quarterly cadence, the structure is obviously going to give us time efficiencies with reconciliations. When you go from 15 pools to 5 pools, when you go from, multiple, I call it the spaghetti bowl is our distributions. It's a spaghetti bowl. We have hundreds of redirects. Some of those are split across two funds, a 90-10, a 75-25. To alleviate that, if we could go to a one fund redirect, if we could just even hunker it down to a few, that would be wonderful. And this investment structure definitely helps propel us down that road to make that simpler. And then reporting simplifications. Continuous accounting is something that I strive and implementing with my crew. I want us to no longer do year-end reporting. I want that to be done on a quarterly basis. And we've been trying to do that for years. And so this, again, a simpler structure makes that more attainable. When you have a complex structure that's unique, quirky, customized, it makes any of those implementations that you should be doing as best practice in the accounting field harder. And so having the simpler structure would definitely propel us down that road. Plan sub-accounting, right, that's our ownership allocation across the pool. So each manager has an ownership percentage of what they participate in each investment pool. The less the pools, the easier that is. It's easier to track. It's easier to communicate with our custodian. It's easier to make those connections. And then obviously audit. We have 80 plus reporting that we have to provide for the audit, special reporting. And so of course, a more standardized structure, a more cohesive and comparable structure makes it not only easier to report for audit, but it makes it easier to audit. And so I think it just is a great stepping, a huge leap in the right direction going this way. And so these are just some of those big benefits, I think, right off the bat we could see with accounting.
Okay, any further questions for Katie? So,
Mr. Chairman?
I do have a question that, in terms of a quarterly versus monthly distributions. I mean, theoretically, if we're computerized to the full extent possible, that's not going to be that big of an issue as it has been in the past, I would presume. In other words, these things happen automatically or at the push of a button in terms of your accounting and your updating and all of those components to it.
Mr. Chairman, unfortunately, no, that is not the way it works because we have a unique distribution process. Again, that spaghetti bowl, that's a customized process that we have to develop with our vendors. It also is 2 accounting systems merging into 1. So there's a lot of balancing and pulling reports and reconciliation involved with just 1 distribution. I have somebody, 2 people actually, that spend 40 plus hours every month to get that process complete. It is not as simple as pushing a button. And even as automated as we can go, again, it's a customized process because we are the only ones that do it that way.
And so, Don, I'm curious how that would impact any of the recipients of the funds, if that would make any difference, and how we also transition if they're not receiving funds monthly. at some point. I mean, is that a real issue, or could it be a real issue? So I just leave that question out there. Go ahead, Patrick.
Mr. Chairman, one thing that I just want to reiterate Katie's comments on the funds. So, on page 2, I showed you all of those 68 funds. Every month, the funds that distribute have cash to distribute. Katie has to send out notices and calculate that, how much they have to distribute. They have to get all that income. It is an unbelievable tough task. And then as she mentioned about the return of the funds, all of these funds, they know we're going to call them at the end. No one else does this. They're like, some of the new managers going, you're going to call back money every month? Are you kidding me? Nobody does that. But that's the system that we've lived with. So what they do is they just hold the cash. So if they have excess cash, and as we know, the markets go up the most of the time. So it's we would have a higher return in that environment where they're fully deploying, knowing that they don't have to every month pull back and resubmit this cash balance. It's a big deal.
Well, that was my next question, is what you do with the cash then? That's the answer, is you.
Yeah, they would reinvest it. They would not. So they're constantly buying and selling securities, right? So in that instance, they go, well, okay, we just sold 5 million here. Let's buy 2.5 because we know Wyoming's going to call back 2.5. So let's just leave the cash sitting there.
Okay. Further questions? Seeing none. Anything else on this subject then? We've got. I don't see anything else other than the subcommittee update. Is that right? So what's next on our schedule?
Mr. Chairman, really, this is the subcommittee
This is the
update because this
subcommittee
is the
update.
topic of the subcommittee's work.
Makes sense. All right then. So we're at
Cash-based budgeting.
cash-based budgeting. You want to take a short break? You want to keep rolling?
Mr. Chairman,
Yeah.
Mr. Chairman, I feel at loss here if we don't provide some directions from the committee to staff and working with the treasurer's office of where we want to go with this. And so I guess I think it would take a little bit of discussion as to whether we want them to start actually preparing something for us to look at concrete to start to do this. As far as,
Well, I would agree with that. I was going to have that at the end of the day, but is there anyone who does not want them to pursue? And why? Speak now or forever hold your peace.
well, Mr. Chairman, the only thing I would like them to do is I think it's easier to subtract out than it is to add on. So what I would suggest is we have them look at incorporating all of these funds to start with. And then as we work this potential piece of legislation or issue, we can start subtracting out the ones that are very maybe difficult or problematic. But that would be my recommendation for the committee to consider.
Mr. Chairman,
Please.
just a point of clarification, Mr. Vice President. So if we go to page 3 and look at the yellow boxes, is that when you say all the funds, you're talking about all those funds? Or are you talking about all the funds listed on all the funds everywhere?
No, Mr. Chairman, the yellow ones that were highlighted in Patrick's presentation.
So any further discussion? I think that we're all on a consensus that, yeah, we should address all the yellow funds. Representative Hallinan, do you have a question?
Thank you, Mr. Chairman. I really think that Representative Harshman's idea about just looking at the common school account, because that's the biggest issue, and I think we could set aside a reserve account for that. And I think that that's what we ought to focus on. Thank you, Mr. Chairman.
And then with regard, and as we move forward, then, and we're talking about creating the one fund and then the one reserve account fund. Do we also need to address the reserve accounts amounts? In other words, where are we going to come up with the money to add in, and how much we really need to add in, and what, if we're going to do 5 years or 6 years, and how we come to that amount? And then the other issue I think we need to talk about is this forecasting for 5 years versus 6 years, and address that issue as well, as we move forward. And where those issues all lead us to, basically.
Well, Mr. Chairman,
Please.
I would say that we can, if you want one reserve account, an appropriation from the reserve accounts that you have and putting it into one takes care of any ownership, because you've done it statutorily. So, you know, there's just money sitting out there, but I don't recall if any of it wasn't put there through an appropriation in any of the reserve accounts.
Well, either short, one time, or continuous.
Yeah. So, you know, as far as the ownership, I don't know whether you've got a problem with that. I don't want to say that to you, but I don't think you've got a problem with it.
It's no different, no different tracking mechanism that we will have with the one fund, though.
Yeah. And I guess I'd say, you know, we can, if you'll instruct LSO to give some leeway to, you know, have a conversation back and forth as far as where we need to and what we need to do to move forward. And I don't think it'll be that much of a different lift by doing all of them and just doing the educational fund, you know. And so we can probably give you that for both. When we can actually do this, we're going to have to make sure that we have our accounting system, you know, through all of its different phases. And I think once we have that through all of its different phases on the build out, then this is going to be relatively easy compared to trying to do this and the accounting system at the same time.
More spreadsheets.
Yeah. Okay.
So, Mr. Chairman,
Go ahead.
so maybe I'm trying to recall, what was the for all the funds that were highlighted in yellow, what was the total liability for that? And then I've got a further recommendation based on the answer to that question.
787 million? No.
Mr. Chairman, Senator Hicks. Yeah, so we are 787 million in the PMTF and 304 in common school.
So it's $1 billion.
Billion one, yeah.
So-
Almost billion one.
So,
But
Mr.
let me take a step back on that, because what we were looking at on that PMTF is at a 5% spend. Because if you did 2.5, we're, okay.
Yeah.
3.75.
Yeah, so then, you know, then you're talking in half of that's 350, 390.
680.
Oh, in total of it, yeah, so 390 plus 3, yeah, so 690, 680, yes. If you
So-
did both of them.
So, Mr. Chairman, what I would like staff to look at to come back, what I would like to do is have them look at. So if we take whatever that number is, whether it's 800 million, 900 million, that we would transfer that out of the LSRA into this reserve account to feed that. And then what ramifications does that have to the guarantees and the backstops on the LSRA, and have that list available? Because if we're going to do this, we need to do it, Mr. Chairman, and right now is probably a good time. My recollection is the projected balance in the LSRA is 1.7 billion plus or minus. Who knows what the market is today, but there's an opportunity that may be here right now, but I want to understand the implications at our next meeting if we just fully funded this out of the LSRA, that liability into that reserve account, what would that entail as far as any statutory changes, any other of those public purpose investments, guarantees that we have against the LSRA?
Well, and I think, there are also guarantees out of the permanent mineral trust fund
Yep.
reserve accounts.
Yep.
So we want to roll all of those and look at which ones we can eliminate. I think JAC has that particular issue, does it not? But we need to make sure we're cross-pollinating both of these issues.
Yeah, Mr. Chairman. And one of the things, and Patrick and I talked about this, that we needed to, and maybe Patrick's already got the clarification about whether or not the LSRA is going to loan the school foundation that another 500 or 600 million, because you paid it off. And that's why you got the 1718. So I don't know if you're going to roll that back out of the LSRA, and we'll be back down to 1213.
Yeah, go ahead.
Mr. Chairman, I think, and I'm going to caution myself not to debate an issue we don't even have in front of us right now, but I think, again, keep this thing really simple to start with and get the most benefit. I'd hate to get bogged down. I think when we see October Craig, I think we're all going to go, holy cow. And I don't think anybody's even going to talk about the LSRA anymore. It's going to be, what are we going to do with the significant surplus we're going to have? And I'm not even going to say the number that I throw around on the campaign trail, but it's a significant amount. And I think, how are we going to save that and invest that in a way that will really reap tremendous benefits for the long term? And I think it is through this reserve account process that we've been working on for a long time. And I think it's just bringing all 90 members, 30 of them will be new or more, maybe half new members. And how do we get there? And so to keep this thing super simple, I'm just cautioning all of us how we do this. I think all these funds are still going to be separate constitutional entities and legal entities. It's about an accounting issue is really what we're talking about. And then having this reserve accounts large enough to guarantee it. So there's a couple moving parts. We're going to have significant surplus. How do you save and invest it for the future and modernize this thing? Because we're not going to probably pass a constitutional amendment making us an endowment where we can dip into the corpus. I just don't think it's going to happen. So this is the next best thing. And so I encourage us to, first things first with this. Thank you, Mr. Chairman.
Okay, we'll take a 10-minute break. Be back at 3:10.
Actually, if you took
Is it? We are back, and we are on cash-based budgeting. Mr. Speaker, come on up. Everyone say cheeseburger. Don, go ahead.
Good afternoon, Mr. Chairman, members of the committee. I was asked to present before you interim topic number 7, which is cash-based budgeting for the Select Committee on Capital Finance and Investments.
Who asked you?
My name is Don Richards. I'm the Budget and Fiscal Administrator for the Legislative Service Office. My presentation will discuss some important definitions up front, a little bit of history, then I'll touch on opportunity costs and what other states are doing in this area, and I'll conclude the presentation with a short discussion of revenue volatility and considerations with any movement towards cash-based budgeting. To begin the presentation, and you should have before you a July 8th memo on this topic authored by myself and Taylor DuPont, a new Associate Fiscal Analyst for the Legislative Service Office. And beginning on the bottom of page 1 and top of page 2, I lay out some important definitions related to cash-based budgeting. First of all, when that term is used, it is often used to refer to budget recommendations, either of the governor or the legislature, limited by available cash, which is slightly different than just cash-based budgeting. It means that the recommendations or the appropriations have a maximum threshold that is limited by the available cash. There is a subset of that definition, which I call kind of 1A, which is budget recommendations or appropriations limited by historic revenue. And that is the approach that the most recent House bill from the 2022 session used. And it was a threshold or a maximum amount limited by the average of the last 3 years, 2 of the last 3 years. In other words, using historic revenue as a basis for appropriations rather than forecast revenue. And then the third, or the third definition there is probably what jumps to mind when the term cash-based budgeting is used most regularly. And that really means cash-based expenditures, meaning that all of the revenue that you or the state enjoys over the course of a biennium is set aside, and all of the appropriations are literally taken out of the cash on hand that was available at the beginning of the biennium. So those 3 definitions are fairly important. We are not talking about cash-based accounting for Representative Obermiller and the State Auditor's Office, which I know are very interested in this. In terms of cash-based accounting, that is separate and apart. That relates to the notion of cash versus accrual accounting. And that really has nothing to do with what the budget is based on. A completely different concept. The goal, as I understand it, of cash-based budgeting is to reduce volatility, to add more certainty, and to remove forecast error. It becomes particularly acute for the state of Wyoming because we have such volatile revenues. So moving to a cash-based budget or expenditures or budgets limited by available cash has the potential of removing some of that volatility and increasing certainty. On the other hand, there are some challenges that may be presented by cash-based budgeting. There may be some opportunity costs and transition and timing challenges that the committee and the proponent should be at least aware of. The next portion of the memo discusses prior bills, and during the interim, I had an opportunity to spend a little bit more time looking into this notion, and it turns out that this notion, that at least what I was able to find, was nearly passed about 40 years ago. In 1983, there was a bill, I believe it was adopted by the House by just 2 votes, and it failed in the Senate by just 2 votes. So it was a very close vote at that time, and it really would have set forth the basis of cash-based budgeting. What was unique then is they set a 10-year forward-looking time frame. So it was a goal that was codified or put into law. I won't necessarily say it was codified, that beginning in 1994, then the state would move to a cash-based budgeting. And this was back in 1983.
What was the annual budget back in 1983?
I don't know, certainly less than $1 billion. It is not necessarily tied, but it is a little bit extraordinary that this was the same year, the interim after this failed, and it was a fairly close vote. The interim that after this failed, Craig was created based on a MOU between Management Council and Governor Ed Herschler at the time.
So I'm sorry to interrupt, but did Senator Scott bring that bill?
Mr. Chairman, he did not. What was somewhat remarkable, and I think I may have even emailed you this, when I looked through the historic records related to this bill, and there was a Senator Perkins, there was a Representative Nicholas, there was a Representative Barlow, and there was a Senator Scott. All of them were obviously other individuals other than Senator Scott who did indeed vote on this legislation. Nonetheless, just for historic perspective, the 1983 session must have had a fair bit of discussion, and we can find that in limited number of documents. We don't have any digest that provides a specific text that I can point to, but certainly a lot of intimating that a fair bit of the time on the floor that session was debating the price of oil as opposed to debating the merits of the appropriation. And both the executive branch and the legislative branch acknowledged that and tried to come up with a different approach to forecasting revenues for the budget, so the debates could focus more on the merits of the underlying budget rather than what the price of oil may or may not be. And hence that created Craig. That issue largely would have been addressed had this bill on cash-based budgeting been adopted as well. Then it moves quite a bit of time until the next opportunity that I could identify that raised this issue, and that was in 2015, and a very similar amendment offered in 2017, which would have directed the governor to recommend his next biennial budget using 1/2 based upon cash from the LSRA and 1/2 using forecast revenues. Now, there was some slight variation in the language between those two, but both of those kind of set in motion a budget that would have been limited by the available cash, at least for 1 year of the biennium. And then in 2022 budget session, the most recent session, of course, House Bill 147 was debated, and that would have limited the governor's future budget recommendation to the amount of revenue collected in prior years. It would have also redirected a number of revenue streams, typically for the purpose of bolstering the LSRA. So very similar to the 1983 approach, where it took 10 years to build up cash reserves, there were several redirections of existing revenue streams in the 2022 House Bill 147 that would have raised the balance of the LSRA. And then finally, that bill would have required additional study. I should also mention that throughout all of this, there is an overriding statute that has been maintained, and that is Wyoming Statute 9-2-1013-D6. This allows the governor, whoever that may be, to submit an alternative budget that is not capped, either under the current process of Craig forecast revenue, which he is capped by, or under cash-based budgeting. The chief executive always has the opportunity, including with all of the changes here, to submit an alternative budget. That option has only been exercised once, and that was in the late 1980s by then Governor Sullivan. Submitted 2 budgets for the legislature's consideration. Next, I talk about some of the details of House Bill 147, and particularly on page 5, table 1 of the memo. It had to address a topic that was referred to earlier today, meaning the level for the backstop or guarantee for the school foundation program, recognizing the LSRA would likely be the source of cash for future budgets. That threshold was reduced from $500 million to $250 million. Then the 1% severance tax and any amount of revenue over the Craig forecast for FMRs and severance taxes was also redirected to the LSRA, again, in an attempt to bolster the cash in that account. And then finally, the bill would have eliminated the SIPA account and kind of rolled that in to the LSRA as well, maintained the guarantee for the SIPA account, but transferred that from SIPA to LSRA.
Go ahead.
So Don, as you read, that was if you rolled that amount traditionally dedicated to the SIPA, was the intent for it to be used again for those one-time expenditures, or was that just intended to cover the cost of general operations of state government? Am I asking that question right?
Yes, Mr. Chairman, there was nothing explicit that would tie those dollars for any specific purpose, unlike the current SIPA, which is dedicated to those one-time expenditures and, frankly, school major maintenance. Nonetheless, I think the cash-based budgeting concept would have covered all of those expenses of the state. Meaning they would not have their own pool of money, but those expenditures, let's say the construction of this building or some future building, could certainly have been taken out of the cash balance of the LSRA.
Follow up, Mr. Chairman. And is it your take, or is it your assumption then the same would be for CapCon as well? We talked a little bit about this on the phone, or do you feel that, is that the concept?
Mr. Chairman, I think the goal would be the entire general operations of government, including capital construction on the executive, judicial, and legislative side. However, I don't believe, and I mentioned that in the memo, that either school operations or school capital construction would be considered part of this cash-based budgeting. It is always, in fact, back to 1983, has always addressed only the general fund side. This bill was worked by the House at the time and had a significant amendment on the House side, revision of the tips for investment earnings, redirection of those over the cap amounts and the 1% severance tax. And it also changed the level of the LSRA prior to moving to the Senate. Ultimately, the bill was not adopted in the 2022 budget session. There was also a similar budget amendment on the House side, which was adopted, but that amendment was removed in Joint Conference Committee, and the balance of this discussion is before you today in the form of an interim committee topic. Now, just like this morning's conversation with the CIO of the State Treasurer's Office, there has the potential to be some opportunity cost if the state desires to transition this way. But the structure of this cost or the structure of cash-based budgeting will determine what the opportunity cost is. And there are many ways to avoid almost all opportunity costs. So let me take both the most egregious example, most costly example, and the simplest example. The most egregious example, the state would actually pay its bills from a fund like the LSRA. Under that example, the LSRA would have to liquidate its investments, and it would have to remain invested in the short-term fixed income markets. And you would have a substantial loss of investment potential in the LSRA. Likewise, the new revenue coming in from sales taxes and severance taxes and liquor taxes, et cetera, for the next biennium would reside in the general fund, which is also not eligible for investment in higher yielding investments like equities or private equity or international stocks and the like. So this opportunity to actually pay the bills from cash on hand really has a chance of losing a lot of investment income. But you don't have to structure it that way. For example, you could limit the amount budget, limit the total amount of the budget by the amount that is available in the LSRA, but not use those dollars. Money is fungible. So you could still continue to use the general fund and the budget reserve to pay the bills. It would just be limited by the cash on hand. And under that type of a structure, you really wouldn't have that lost investment opportunity. So while I listed out on table 2, page 6, the various yield forecasts of the funds, and there is 1% to 2% lost yield, those only come into consideration if you're actually using cash on hand to pay the bills and then building that back up. It is not the most efficient way of doing this. You can get to essentially the same outcome by just semantically limiting budgets to cash on hand and not actually using the cash on hand to pay the bills.
Please.
So, John, if you move the LSRA funds into that account, do the obligations or the backstops we use the LSRA for stay in place and just be committed to that fund?
Mr. Chairman, Representative Larson, I think that is a great question, and it's one of the considerations that I'll refer to a little bit later on. In layman's terms, what I would say is you can only spend the same dollar once. So you can either continue to maintain those backstops, those insurance policies, have money available for wildfires, have money available for EGI overruns, that's employee group health insurance overruns, or you can use them for cash-based budgeting, or you can use them for deposits into the reserve that was discussed earlier today, but you can't do both or even all three. So those dollars the current guarantees would have to be considered like House Bill 147 did in lowering that threshold.
But, Mr. Chairman, but it only lowered the threshold on the commitment to education, not the other things that we have, right?
Mr. Chairman, that's correct.
Thank you.
When you look at other states, I could not find any, and I did reach out to a number of think tanks and a number of our colleagues. No other state does this. So that section is pretty short in that Wyoming would really be on a leading edge if the state elected to proceed in this approach. We're already on the leading edge in many cases in our finances. So for example, when I speak to my counterparts, our capital construction is paid for largely, I know there are a few exceptions, but largely with cash. Cash on hand. We built the Capitol complex by saving over a decade in advance of the construction of that building. That's typically not the way other states do it. They take out bonds to pay. So this is a continued movement in that the state of Wyoming, if cash-based budgeting were to come to fruition, would be paying its operational expenses in addition to its capital expenses with cash on hand, or some version of that. One of the advantages or potential advantages of cash-based budgeting is to address revenue volatility. And I think that's worth mentioning since it was one of the justifications for cash-based budgeting. And the average year-to-year percent change in the general fund and budget reserve account over, I believe, the last 40 years has been 6.2%, while the average biennium to biennium change is about 10.3%. Somewhat surprising to staff anyway is the standard deviation of those changes was almost identical at 15% for both the annual change as well as the biennial change. I frankly expected to see even more smoothing from the biennial budgeting. There is smoothing, but I had anticipated to see even more smoothing. So on page 8, you can see this graphically in figure 1 and figure 2. 3 points I'd like to point out. Over the last 40 years, you can see the annual percent change in revenue collections have been negative 5 times. And these are not inconsequential changes, particularly 2016. You can see it was over 30% decline in 1 year. We say the average volatility is about 13% change to the positive side or the negative side. That is really remarkable. When I talk to my colleagues in say Minnesota, for example, theirs is around 2 to 3% change. I ask them how do they do their revenue forecasting, and they say, well, we rely on the durable goods information from the Bureau of Economic Analysis. And I thought, wow, that would be nice. Our revenue streams are dramatically more volatile.
Please.
That rebound in 2017 and again, well, maybe in 21, does that take into account any of the federal stimulus money, or is that just our general traditional revenue streams?
Mr. Chairman, Representative Larson, that is only our traditional revenue streams. What you can see in Figure 2 is that you dip below, you dip negative fewer times. Only 3 times did we actually dip negative on the biennium. And I don't believe if we were to add 21, 22, it's not complete yet, but my guess is we will be about flat, meaning we will likely not dip negative for the current biennium. This average 10% change for the biennium with a standard deviation of 15% change is pretty remarkable. That means 0 is included in there, and you have a 7 out of 10 year chance that it'll be somewhere between -5 and +25%, which is a pretty wide area. And it also means in 3 of those out of 10 years, you can expect something further from that average, meaning more spike in revenues or lower spike in revenues. Nonetheless, you can imagine a good reflection as to whether or not this notion has potential is this current biennium that just concluded. If legislators knew in May of 2020 what they know today, would you have made different decisions along the way? So we had, even though it won't show up here much on the graphic, we had an enormous decline in revenue, but really that was spread over 2 fiscal years. Fiscal year 20, meaning the first 3 months of COVID, and fiscal year 21. And then we had a pretty strong revenue year, particularly the last half of fiscal year 22. So when you look at this from a biennial standpoint and you compare this to our January 2020 Craig, it's about right. Now, we had no idea going along, and when we looked at it in May, of course, it was a disaster. And frankly, LSO or Craig undershot. You know, we were overly pessimistic in the summer of 2020. Of course, we did not know all of the federal action that was yet to occur, but we produced a revenue forecast which legislators and the governor relied upon, which in hindsight may have led to inappropriate decisions being made. It was the best information at the time. I'm not suggesting that we sandbag this, but knowing that history, the benefit of looking back and using known revenues might have some merit in this cash-based budgeting. There are also a number of potential considerations, and I will also, before I go through the considerations on page 9, the co-author of this memo, Taylor, just started work in about 7 weeks ago for LSO, and he's done some pretty interesting work for LSO and Craig already. And let me point out 2 of his studies that he's done. One, I wanted him to look at Craig's accuracy. And if you could come up with another model aside, just a statistical based model that would be any better. And to date, he has not really been able to identify anything better. And Craig beats the fact of a random walk. I know that's a tremendously low bar, but we're better than random. We're also better than the last 2 years. So if you were to use the last 2 years' actual revenue versus the Craig forecast is more accurate in projecting. So there's something that goes on in that room that adds additional information rather than simply relying upon what did you get last year and what did you get the prior 2 years. Now, what he has also identified is that our error rate, which is not horrible, our error rates are correlated. And what that means is there's some other piece of information that is not being taken into account. And it's not a huge thing, and it's almost insignificant when it comes to sales and use taxes. But when it comes to minerals, we do have an error rate that is to the low side. Now, let me be very clear. We do not intentionally underestimate. We do not intentionally underestimate. However, I have mentioned this in many different meetings where Craig tries to hit the revenues exactly, but if we miss, we want to miss low. Well, that theory is really evident in the data because we are missing slightly low more often than we are missing to the high side. So our error rate is kind of to the left-hand side rather than to the right-hand tail. Not by a significant amount, and it is not an error that I would like to add to each of our forecasts to correct. Meaning, if we even identify, okay, we're typically on average, say 2% low, I don't want to come up with Craig's estimate and then add 2%. I want policymakers to acknowledge our process and how close we are in many cases, but we are more conservative, or we're conservative more often than we are overshooting things. Now, finally, in conclusion to the memo, I identify a number of potential considerations. These are not necessarily challenges, but they are things that policymakers might want to contemplate when they're considering moving to a cash-based budgeting. First of all, there are some potential legal issues which have not been thoroughly reviewed by LSO legal staff. For example, there may be some additional limitations regarding separation of powers, depending on what approach you use, whether you put this in the budget bill or a standalone bill. And this might require some further analysis. There might be additional challenges like whether or not a legislature can bind a future legislature. One of the important contributions here is what is the culture of the legislature? So there are really two potential paths if the legislature were to implement cash-based budgeting. One is it becomes part of the culture of the institution. And by that, an example is the 5% statutory reserve amount. That is a statutory requirement really only on the governor. The legislature is not subject to that. But there is an extraordinarily strong tradition within the legislature to always leave town with that 5% left in the statutory reserve amount, in the budget reserve. You'll always see that 100 million, 113 million, it changes from time to time. I've only seen once where they have left town below that amount, and the next year they immediately restored it. So that is kind of a culture. There is also another culture where legislators from time to time will use the term notwithstanding. So they say, we recognize what prior legislators used, but notwithstanding that, let's do this time. And that is an indication of where, cash-based budgeting, even if this legislature decides to be bound by that, it may not hold, or that practice or tradition may not hold for future legislatures. The second item here is the impact on revenue expectations. And under the current approach, revenue forecasting introduces potential errors, right? We have the volatility of the oil and natural gas and coal markets. In addition, which is very volatile, in addition, we have forecasting errors. And if you base this on knowns, you can remove those forecasting errors. However, it would also introduce a concept which I mentioned. Craig is actually performing better than historic actuals. So if the legislature relies on historic revenues and you are in a declining revenue environment, which we essentially have been over the last 6 or 8 years, then cash-based budgeting would lead you to expend more money than you should, because each successive biennium you're collecting less. So relying on historical revenues or even cash on hand from the previous biennium will not always yield a more conservative approach. It could I'm not saying it will, but it could lead policymakers to spend more than they otherwise would have. The third consideration is one of timing. And there are a number of issues here. There are some administrative impacts to state agencies, to the state auditor's office, to LSO, depending on whether or not the legislature desires to do this for a 1-year or 2-year budget. That would also have timing impacts. And then if you are interested in moving entirely to 2-year cash-based budgeting, unfortunately, the bar is going to be a little bit higher. It's going to be about 2.25 years of budgeting because you have to take into account the 3 months of accrued revenue. So it's not quite just 2 years. You really need to have 2.25 years to be completely safe. The fourth consideration is the calculation of the balancing. And this one you can certainly address, but asking the state auditor's office what the cash balance is as of a certain date of time is not a simple exercise. About 10 years ago, the legislature actually put in statute for the state auditor's office the method they should use in cash-based budgeting. Even since that statute, you will see different administrations calculating that cash slightly differently. I'm sure these things can be addressed, but that is something to keep in mind. What does cash on hand at a point of time mean? And will it always mean the same under successive administrations? If you say the cash on hand in the general fund, well, for years, we have also deposited federal funds in the general fund. Up until about 4 years ago, our federal funds were commingled with our general fund. Well, of course, that will yield a substantially different outcome than perhaps legislators expect. The fifth consideration is competing demands, and this was referenced in my response to Representative Larson's earlier question, in that you can only spend money once. So once you take a reserve, whether it is the LSRA or the PMTF reserve account, and use that to cover the operating expenses in the future, you can't use those same funds for other purposes, guaranteeing investments, backstopping K-12, providing emergency funds in the event the governor deems a public welfare emergency or a wildfire or the like. The sixth consideration was previously mentioned as well. If you actually use the LSRA cash, of course, it can't also be invested. So one of our revenue streams, when you read the Craig report, is called pooled income. And it generates $20–30 million per year, $40–60 million per biennium. Well, if the LSRA is used to pay bills, it cannot also be invested in equities, and that revenue stream has the potential to be diminished. And then finally, the question, which I've alluded to previously, today there is insufficient funds in the LSRA to have a biennial cash budgeting, but there is sufficient money to do annual cash-based budgeting. However, if the state moves to annual budgeting, that may have some impacts on your work, meaning the 20 versus 40-day session, having an annual budget each year rather than a biennial budget, those sorts of things. These are just considerations for your thoughts, and I'd be happy to answer any questions.
Questions? Representative Larson.
Mr. Chairman, so I would assume, Dawn, that interagency reversions would just come back into the next year's cash balance. Is that the way you would see that?
Mr. Chairman, that's a good question. I haven't given it much thought, but I would anticipate that it would continue in the same approach, meaning it would be deposited in the budget reserve or general fund or some account and available for appropriation the following year.
The following year. And then I've reread after your conversation with me on the federal funds, and just curious again, sometimes as our appropriations of general funds impact the appropriations of federal funds. Do you see any complications on a cash-based system versus what we have right now, I don't initially, I just know that that's significant in Department of Health and in other agencies, and that would still remain the same. Whatever funds we have available to be met by federal funds, then so be it, and it's not necessarily guaranteed each year.
Mr. Chairman, Representative Larson, I think there would be some muscle memory or challenges for agency operations. That's not to say they couldn't be overcome. And this would not necessarily take place in the transition to cash-based budgeting, but rather to annual-based budgeting. Wyoming is one of only 2 states that has true biennial budgeting. There are a dozen or so states that actually have biennial budgeting, but within each year, agencies are held to spending that year's appropriation within that fiscal year. In Wyoming's case, and North Dakota, I believe, were the only 2 examples of this, a 2-year appropriation can be spent over the course of 2 years. That actually helps our social services agencies like Department of Family Services, Department of Health, because our state fiscal year does not align with the federal fiscal year, and it gives those agencies that have federal matching funds, DEQ is another example, to maneuver those funds to more accurately match the federal fiscal year. It could be overcome with annual-based budgeting, but it would take some learning.
Go ahead,
So,
Mr. Kutcher.
Could you speak to volatility a little bit? And maybe I misunderstood, but it seemed you thought that, or one of the thoughts was that the move to cash-based budgeting would decrease volatility. But ultimately, if annually our revenues are moving 6% on average, how does that change the volatility other than the fact that your volatility is behind you instead of in front of you? Does that make sense? My question?
Mr. Chairman, yes, I had expected almost all of the, I had expected that the biennial look would be even more smooth than what it turned out to be. It still looks not nearly as bad as the figure 1 graphic, but it still has some pretty big spikes and pretty big troughs in that. So erroneously, I had anticipated more of a smoothing. If the legislature decides to proceed to budgeting based upon prior revenues, you really don't have any change in the volatility, but what you do have as policymakers is up to 2, potentially even 3 sessions to prepare for the downturn. So for example, you know it's coming, and you won't have to make decisions on that. For example, you'll be able to know that COVID occurred and won't have to pivot as quickly because all the way through fiscal year 21 and 22 would have been based on 19 and 20 revenues. And it would have given policymakers 2 additional years to contemplate what is the appropriate response to COVID.
Mr. Chairman, that's if we cash-based budget on a biennial basis.
Correct.
But if we cash-based on an annual basis, how does, I mean, the only thing happening is, for you, so for example, you go back and look at the chart in 2015 to 2016, 2017, we had the financial collapse, wasn't it? That was, no, go ahead.
Mr. Chairman, that was really the April of 2016 was the collapse of the energy markets.
Yeah. And so I mean, so in this scenario, so going into, in 2015, you budgeted based on cash base. And so you're spending available cash. And so that works really well because you have this collapse, you've already got the money in the bank, so you don't have to make wicked adjustments. But the next budget year, now the available cash has shrunk dramatically because all you have, because of the collapse, the oil price, then the collapse in the energy markets. And so haven't you just I mean, you don't have to run and change because your forecast is wrong, but how's it decrease volatility? Because you still have now, you're just absorbing it at a later time. How does that change the volatility? I'm still struggling with that concept.
Mr. Chairman, I would concur with your annual budget, and cash-based budgeting really would not change much of the volatility, other than it would be known as opposed to unknown. So Craig or any reasonable forecast might fear that this downturn will continue or be worse than it actually was. So you would potentially remove that error rate, but you would not remove the underlying volatility on an annual basis.
Mr. Chairman, let's follow up. So the way I would see this working is if you went to the cash available budgeting is, I don't see the function of Craig changing very much because that forward-looking analysis is still very vital. In fact, to me, it would, if the way I'm thinking about this, if you did this, is it would actually, it would have some effect on the cash available budgeting. You're still limited to the cash available. But if your Craig report is showing continued downturn or continued decreases, you're likely to continue to, you're not going to necessarily budget all the available cash. You're going to figure out how to start to feather it back to, so that the next, so your budget isn't doing that very thing. Is that kind of, that's my thought. I just wondering how you would see that just, just as a practical matter working if we moved in that direction with the marriage between the cash-based budgeting and what Craig does.
Mr. Chairman, Senator Perkins, I completely agree. I think the real potential benefit is with the 2-year cash-based budgeting, and the benefit is removing the error to the extent there is one and providing more time. Those are kind of the upsides, if I see.
Mr. Chairman,
Go ahead.
kind of along these same lines. And so when we look at that graph on figure 1 and figure 2 on page 8, Donna, it seems to me like when I look at that, even if you're going to an annual or a biennial cash-based budget, you're still going to want to retain a reserve account, and a reserve account ought to at least cover on an annual basis the 40-year history of our worst occurrence, which was 2016, that we would still want 35% in reserves above and beyond whatever that previous year's cash-based budget was. And so under those scenarios, would we still have enough available funds to go to an annual budget now if we also maintain a 35%, I'll just call it volatility reserve account? But I think that gets to that question of smoothing that out that extra year if you've got those reserve accounts also. Could you speak to that?
Mr. Chairman, Senator Hicks, I think that is a wise point to acknowledge the notion that moving to cash-based budgeting would not remove legislators' desire to have an additional reserve in the case of challenges. What it would provide you is you're always generating 2 more years of revenue while you're spending your cash. So if worst came to worst, you could always return to budgeting based on revenue forecasts. And that could be, at least in your mind, a potential reserve, because you've got 2 more years of revenue that you have not yet budgeted. So does your reserve need to be the full 35%, or could it be somewhat smaller than that? That's a question for elected officials, not for staff. But would reserves go to 0? I would concede there's a strong indication that other actions would come up that policymakers would want to have a cushion. And in terms of your more specific question, do you have enough money today to move to 1-year budgeting and a 35% reserve? The answer is no. Will you in October? I think it will be close. However, you will also have to give up those other obligations against the LSRA.
Representative Bowman.
Thank you, Mr. Chairman. So let's go back to the year 2020. That's what precipitated this, and look at the options we had at that time. The Craig came out in May, and the estimated general fund loss in May was somewhere around $877 million. And my understanding is that the governor looked at that and he said, well, our approach will be that we'll cover half of this by cutting the budget, and the other half will cover with the LSRA, which had 1.5 roughly billion dollars in it. So we get to October, and now the estimate is that it's 455 million, not 877. And the governor decides that he's not going to use the LSRA at all. He's just going to go with the cuts. And that's what we did. It was a political decision to go with those cuts because we didn't have to go with those cuts, did we? We had an option of fixing that out of the LSRA, cobbling together the money, not to take those hits. Would that be an accurate statement?
Mr. Chairman, I think all of that is an accurate history. I will mention, just because it was my concern at the time before JAC, is I repeatedly indicated any reductions, the earlier the better. So I have to own that statement, because if you wait till the end of the biennium, the reductions may very well need to be higher. So that 15% could become 30% if we don't see a rebound. With that caveat, I think the history you described was correct. $800 million plus. It was roughly half and half cuts and potential use of savings. And then ultimately the resolution was cuts with what I will say limited restorations during the session and then the subsequent session.
Mr. Chairman, then a follow-up. Let's say cash-based budgeting had been in place at the time. So we come into this year, and in May, you're looking at the same scenario, tremendous drop in revenue. But our budget is based on the last 3 years. So is it even realistic to say that no one would care that we just had our budget in place, that we didn't have to deal with an $877 million drop in estimated revenues, as if we can just ignore what's going to happen in the future? It was the point that Senator Perkins brought up. The Craig piece of this is always going to have to be there. So in that scenario, can you envision what would have happened with a cash-based budget in place? How would we have dealt with the $877 million? What would have been our options under that scenario?
Mr. Chairman, I can't predict what the legislature would have done under that. But what I could say is the policymakers would have had more time to consider that. They could have initiated immediate reductions as if future years, 22, 23, 24, will also be negatively impacted. Or they could say, wait a while and let's see what happens. I can offer that only one state did the latter. The state of Wisconsin refused to change their revenue forecasts. They were the only colleagues that I engaged with, and their legislature did not take the cuts. And at the time, we were like, what are you doing? But that's 1 out of 50, 2%. I don't know, if legislators knew the trajectory and said, well, we have 2 years to think about this, because the nice thing about COVID timing is it was right at the beginning of a biennium. And perhaps members would say, let's see what happens. Let's see what happens for a year. Let's stay the course. Or they may very well have said, this isn't coming back anytime soon. We need the 15% or some variation of that.
Mr. Chairman, I just want to follow up here. So now that we have the history and it came back, all turned out well. If it hadn't come back, then this last budget session we would have been dealing with, we would have just deferred a problem for a year, but we would have still had the problem. We had an easy budget session because we were coming into it having cut it $429 million before, and it just righted the ship. I don't know that any legislator right now is regretting how that came down. That's just a comment. The other piece of this that I wanted to ask you about is you talked about which method is most conservative, and it seems to me like your current method is slightly more conservative because of your hedges that are built into it. That 2.5% spending policy, that's a hedge within the concept of how much revenue the general fund is going to have, right? 2.5% is what you profile. So any revenue beyond what your estimate is going to count as additional revenue. You've hedged against that. And the other one is you're talking about, or the current system builds in the conservative estimate trying to err on the low side. So you got two hedges that, to me, make it sound like our current system is working to be the most conservative way to do it, and certainly more conservative than if you just went with a cash basis. What do you think about that?
Mr. Chairman, I think the spending policy was designed to add that conservatism. That's not a Craig issue, but that is a statutory issue. And I think that, as I previously said, Craig does try to hit the mark, and if we miss to the low side, we do miss. So in 2016, that was a flat out error, and it was a big error, and it was, significant. So under cash-based budgeting, you would have been able to use the prior year's 13, 14 in that case, so quite a bit in arrears, known collections, as opposed to the 2016 estimate, which we admittedly missed. Whether or not it is merely kicking the ball down, kicking the can down the road, that is certainly possible, because you would have to deal with that decline in actual revenue at some point as well.
In your opinion, does our current system work?
Depends who's sitting here.
Does our current system end up doing what we want it to do in terms of the budgeting process? Do you think the current system of the Craig analysis works to arrive us at a place where we can make proper decisions about the budget?
Mr. Chairman, Representative Obermiller, first of all, I have a bias, admittedly, because I'm a product of the system that we're currently operating in. And I believe I have looked at other states, and I think the Craig process is far and away better than many, if not most, alternatives. There are still almost half of the states that have independent revenue commissions, meaning the executive branch and the legislative branch, and not a consensus group. The federal government is a great example of that with CBO and OMB, and the president's budget, regardless of party, is dead on arrival. I think that's one of the worst systems out there. I think Craig's approach to a consensus budget has worked well, but it is not infallible. We do have errors, unintended as they may be, and sometimes they're very large. And I do have some caution as to, do those errors introduce results, meaning overspending or inappropriate reductions to government services that would not otherwise be made. In general, I think Wyoming system, with all of the checks and the balances and the democratic process and the separation of powers and the Craig Rev, tends to work very, very well. That's just on the budget side. In reflection to this morning's or even this afternoon's conversation preceding this, there is ample opportunity for improvements, either accounting wise or budgeting wise. And I think that's just a natural outgrowth of a well-functioning organization that each legislature makes incremental improvements.
And Mr. Chairman, is cash-based budgeting, in your opinion, an improvement?
Mr. Chairman, that's probably where I'll draw the line and say that is a decision for legislators. We can operate under either.
Okay, further questions? Further questions? All right, Mr. Speaker, you want to give us your 10-minute pitch?
Thank you, Mr. Chairman. Thank you, members of the committee. I can do it in a lot less than 10 minutes. First of all, thank you to Mr. Richards for 6 years now contemplating this. And he's done the same thing with me. He said, I don't know if this is better or worse, but it's something to consider. My experience in state government is actually 16 years, because I was on the Wyoming Livestock Board in 2008. And if we recall what happened in 2008, we had a sudden, catastrophic, or significant drop in state revenues. And the governor at the time, well, it was kind of a bridge between two governors, if I recall correctly, basically said, start cutting, just start slashing. And programmatically, things were impacted significantly. And some of you were serving in that time, and it took 2 or 3 or 4 years just to get back to, we understood what services the citizens of Wyoming were getting. And then bringing down 2015, and then this most recent. So the premise that this came out of somewhere, this last episode is incorrect. Very incorrect. My own experience is 3 times where we have gone in with the legislature and the executive branch, and that's actually where I do have some problem with the separation of powers. We're actually giving the executive branch a lot of authority in our current system to alter programs that we appropriate for, that we authorize and appropriate for. So when I look at it, I think this puts it back into the legislator's hands more firmly, so that we're looking at the horizon, not looking at the front bumper. And that's what this transition does. Now, the conversation was happening this morning about better investment. All of this plays into this. This is for me, this is holistic. This is part of the entire discussion. And but the programmatic side, and let's face it, I served on labor, health, and social services for 8 years. I heard the stories about we cut programs, and then now we're paying the price somewhere else. Recidivism, when you cut substance and mental health, we did that in 2016. Recidivism went up, prisons got filled up, and then what we were dealing with. We're talking about something with the state penitentiary then. Some of you were there for those discussions. So what I guess I'm saying is I think this type of approach, coupled with other good policy type discussions, we can get to a place where we actually have a longer vision and more time to actually adjust to the challenges we have with revenue volatility and the impact that has on the programs that we authorize and then fund, authorize in statute, codified statute, and then fund in our budget. And then when we get in a bind, guess what? We turn it over to the executive branch and say, oh, do what you got to do. Do what you got to do. Like I said, I've seen it 3 times in the 16 years, and this is where this comes from. It comes from we can do a better job. There has to be a better way of approaching this, a more sustainable, smoother. Somebody used the word feathering. I don't know who used that word, feathering, of we got a challenge, we come back out of it. We got a challenge, we come back out of it. And that's the impetus for me to be interested in this concept in conjunction with some of the other good work that this committee and other folks are doing. So thank you, Mr. Chairman. Stand for any questions.
Mr. Chairman?
Go ahead.
Yeah. Mr. Speaker, question for you, looking at this thing and those scenarios you described, would we have been better off under an annual budget or a biennial budget to try to smooth that out? What's your perspective on that?
Mr. Chairman, Mr. Vice President, so I guess I'm the least qualified person to say anything about the budget because I've never been on appropriations. Everybody else in this room has been on appropriations, I guess. But I would say that, you know, I think that there is also, when we talk about the separation of powers and the ability or I think the requirement for the legislature to be closer to or as close as possible to both the purse strings, which we're obligated to be, and the programmatic stuff, an annual budget makes more sense. I know that's a tremendous amount of work for the folks that actually serve on appropriations. Maybe there's a way to, you know, adjust still with biennial budgets, but you only take up half the budgets every other year or whatever it is. I don't know what that is logistically, because I know it's a tremendous amount of work that you and your colleagues on a JAC do. And so maybe that's a part of the discussion that we go forward with. I can't speak to the practicality of the work that goes into the budget, which obviously Mr. Richards and his team and the members of JAC are much more attuned to.
Yeah, Mr. Chairman, just to follow up there, on the broad sense, I would concur with the speaker that it provides a little more oversight of the legislature of the budget strings on how government's funded on an annual basis. But specifically, what I was trying to ask, Mr. Speaker, in your experiences with these deep cuts and then the time that it takes to rebound back to get these services back through whatever agency, livestock board, Department of Health, that may be, do you think we'd be better off with an annual versus a biennial in that case? I'm particularly looking at the historic data.
Mr. Chairman, again, maybe that's something that we ask LSO to actually take a look at, maybe a couple different circumstances within that budget history we're talking about, and see what restorations and what time frame they occurred in. If you look at the you know, the Medicaid or, you know, some of those things, you know, we reduced reimbursement rates. Well, some of those have not been restored still, and yet, so we have impacted programmatically things even longer term when revenues have improved. So, but I'm sorry, Mr. Vice President, I can't speak to the annual versus biennial budget. I mean, there's, like I said, there's chairman and former chairman of JAC here who can talk to that much better. So I apologize. I can't speak to if it's an improvement or not. I would say, though, that the interesting thing that Mr. Richards brought up is, you know, you get a biennial budget, but you don't have to spend any of it in the first year. Let's say the program don't have the federal match or there's something, then all that money gets laid over. So it probably does give the legislature more oversight into the programmatic, you know, programmatic type things. Thank you.
Let's go, Chair.
Thank you, Mr. Chairman, and Don, you may want to wade in on this, but you know, I was trying to think about this. I'm very loath to go back to annual budgeting, and I think to some degree, if we whether we do it this way or not, if we went back to annual budgeting, I don't know that we've done anything to really change the volatility. But if you did go to the 2-year, I can see where there's some benefit in that regard for that very reason. I think it gives you already know that you have the money to pay, and so you can be. I think you don't have to be as drastic or as emergent with trying to figure out the cuts, but at the same time you go back. The longer you put off a reduction, the more that reduction has to be in order to get where you may need to be. So I'm trying to figure out have you given any thought to how you move from this 2-year forecasted to a 2-year cash available, or kind of we'll call it cash budgeting, but I think we know it's a cash available budget. with the fact that we only have 1 year's worth of budget on the first day. So I'm just wondering if you get any thought about how you make the transition. How do we make the transition?
Mr. Chairman, thank you, Mr. Chairman Perkins. So I think that if we go back to 1983, they anticipated. Certainly our budget was a lot smaller, but our revenues were a lot smaller in 1983. And actually 1983 and 1984 and 1985 were really tough times, at least in Northeast Wyoming, which I would argue is, one of the engines of the state of Wyoming as far as revenues, coal, oil, gas, et cetera. I mean, it's everywhere in the state, but in my community, there were empty houses. Most of my classmates went to the military because there was nothing there was very little in Northeast Wyoming. That's just a reality for that time frame. So I think there's always previous efforts to this, nothing new under the sun, right? They knew there was going to be a transition. In 2014-15, and Mr. Richards can affirm this, I believe is correct, we actually had the cash on hand to go biennial, just like that, or very close to it. Now we're at 1 year, but then I think what you do is you just spread it over 5 years and you just transition and you just try to set aside that 15 or 20%, and then that has a value, that has earnings too, and maybe in 5 years you're at your 2-year place. Start with one, and then you just build the reserves toward that. Still having the backup, the 35% or whatever folks were interested in, and having that as part of that reserve account or building account. So I think it can still be done as a transition. Mr. Richards has probably thought about this a lot more, but that's, I guess, how I would approach it. Not knowing we don't have 2 years to begin with, just gradually get there. The other thing I would say is you can still biannually budget and annually cash fund it.
And that's kind of,
Mr. Chairman.
Mr. Chairman, that's what I was kind of thinking. There's you cash budget based upon what, it would be obviously be a combination of what you have on hand plus what you anticipate. And then as you came into the second half of the biennium, you'd be looking at that and seeing if you've been where, but anyway, that you can see where you are, and then you'd have to make those mid-course corrections. But I think even in cash-based budget, you're going to do that thing anyway, because you have to continue to look forward. So you can, like, duck smooth or feather your budget to where you think you're going to be.
So
Your comments.
Yeah, so thank you, Mr. Chairman, if I could respond to that. So actually, in the scenario that, and I've shared this with Mr. Richards, is if you have 1 year on January 1st of money, your fiscal year doesn't start until July 1st, then you've had another 6 months. You have 18 months worth of revenue accumulated before your fiscal year starts. So by the end of by the 6-month point in your fiscal year, you have now accumulated potentially all of the revenue. And then you have a intervening legislative session, at least one, and sometimes two, as you smooth out any significant volatility. And that's one of the things, because we tax on a calendar basis. Ad valorem, we collect different times, but really we think about our revenue sources on an annual basis. On a calendar year basis, we're always 6 months behind that in our revenue, in our budgeting, in our budget calendar year. So you automatically have 6 months, you start with a year, now you're at 18 months, and then you can add to that. And Mr. Richards he's done those numbers, and we've, wrestled back and forth. I don't do much of the wrestling. He just tells me what it should look like. But I think there is a way to make that transition. Thank you.
I think Don had some comments.
Mr. Chairman, I think the biennial budgeting does, as indicated in Figure 2, does provide some smoothing in this. However, if the goal is really not to use the actual cash from the savings account to pay the bills, but rather use the amount of cash as a limit or a ceiling on the budget for the ensuing year or biennium, there are a number of different ways as the speaker mentioned, and even in House Bill 147, using a smoothing average of actual revenues, using Craig and a combination of cash on hand, which was in a previous budget amendment, but it even doesn't even have to be by year. You could take the cash on hand and the next two forecasts, or 1/3 of the threshold or ceiling is based on the actual revenues, 1/3 is based on cash on hand, and 1/3 is based on a forecast. If the goal is just only to provide a smoothing effect, there are a number of different ways to do this, and the amount of money on any particular day is not necessary in order to make that transition.
A veritable smorgasbord of budgeting options.
Mr. Chairman,
Go ahead.
thank you. So I'm going to start with an analogy. Some of you know I have some musical inclinations, but I cannot play drums because there's just too many different things going on at one time for my brain to grasp and my muscle memory to work through. So using that analogy, we basically had two conversations today about cash-based budgeting and how we restructure all of our funds. And my concern is that from an administrative perspective, if we try and do both these things at the same time, is that going to create unnecessary complications for instance, the treasurer's office? So I'm initially asking it to Don, but it's whoever's available to answer that question. I would be curious.
Mr. Chairman, as I stated in the memo, I think there are ways that are very administratively complex, and then there are easy ways which would not require a whole lot of change to our current system. So I think there is a easier approach. What I am concerned about with respect to Representative Schwartz's question is there's, practically speaking, insufficient dollars to do all of these priorities. You can either fill up your reserve accounts or you can move to a cash-based budgeting. But there is, there's some middle ground there, as indicated in House Bill 2022, because we didn't have enough cash on hand. It used a surrogate or a proxy for cash on hand, and that was historic revenues. So, there are different ways to approach this, and to Representative Schwartz's question, there are approaches that are not administratively complex.
Well, Mr. Chairman, and so going just back to Andy, I mean, if you go back and all you do is you say, we're going to limit the general fund budget to whatever the general fund revenue or general fund BRA revenue was for the last 3 years, and the average of the last 3 years, or last 3 years, double that, or whatever we're going to do for the biennium, you do that. That's just an artificial construct. It doesn't really affect anything. It doesn't, we're not spending the same dollar twice. We're just saying, those are the limits we're going to budget under. And ultimately, it seems to me almost have the same effect, but anyway. And Andy, does that make sense, or is that just mess it up more?
Mr. Vice Chair, it makes sense. I just have a concern that we will not maintain that simplistic approach, because we seem to have a capacity to make things more complicated than they need to be.
Thank you, Mr. Chairman. Don, all these mechanisms for deferring and smoothing, putting off the hard decisions, that kind of thing, aren't they already built into the system we have? I mean, we have those options for deferring and smoothing, do we not, under the current system?
Mr. Chairman, a lot of those are available, and the way I would describe it is saying no is always an option, right? For a request, and any legislator, I know you do a lot of individual preparation. If policymakers are maybe concerned about putting some of these things in statute, that does not mean this committee cannot direct Craig to tell us what the 3-year average revenue is. if that were to be the case, so you want a number out there, that's a simple calculation, or those types of things, when you're debating this on the floor, how much cash is in the LSRA, and you can double it or not. And so I think there are a number of approaches, including a statutory approach that could be pursued here.
Further questions? Eric, you had some more comments?
Mr. Chairman, committee, thank you very much for your consideration. I view this as another way that the legislative branch exercise its full responsibility and authority in both providing services and doing so in a way that is most responsive to the challenges that we can face. I also think it helps give us, we haven't even talked about the K-12, and that's the side we have deficit on. Or, I mean, you've talked about it, but in this discussion is, if we provide more stability on the general fund side, to me, or more predictability on the general fund side with our budgeting process, to me, that helps us on the school side, because that's where we're making up some of that right now. That's the backstop, whether it's LSRA or actually expenditure. So I appreciate it. Have a great rest of your day. Safe travels for those that are traveling, and thank you.
Okay, any public comment on our discussions with cash-based budgeting? Any public comment on anything that we've talked about today? Seeing none. Do we have any comment from the body, the committee, on cash-based budgeting, or thoughts on further questions or procedures, purposes?
Thank you, Mr. Chairman. I think if the committee's interested, I think the bill that passed the House last year was a pretty good start. I think it took several parts to try to pull the money together in a moderate kind of, I mean, you're going to have to give up some money somewhere and to kind of pool it all in. And so I encourage, I mean, that took it was LSRA, it was reserve accounts, it was 1% severance, it was FMR, it was severance tax, and a little bit of everything trying to get to that point. So I think it's an interesting look. And then just so I have in my head, I mean, really, today I'm thinking, I mean, if we wanted to fill up the reserve accounts so we could invest them for growth and not the income, and it's 300 million in the common school reserve account and about 390 in the permanent. Okay, so 690 is called 700 million to fill those up, to generate about 100 million more a year. That's my little league math on the thing. It's pretty good. I mean, you put $690 in your savings account, get another $100 at the end of the year. I think we'd all take that. I don't know what that percentage is, 13, 12, some of my little league math in my head right now, but so how do you do that? And then to do cash-based budgeting with that, what's our budget now, biennial, 2.7? So, or if you do annual, then you got to come up with another 1.4 or so. You know, if you're gonna.
You have to go with anything.
So, I mean, this thing is doable. I think if you could probably do both. I don't know if you could do a 2-year cash and fill up the reserve accounts. Then you're looking at a current budget. What are you looking at? About a 3.4 billion. Ooh, I'd have to scratch my head a little more on that, just to even, a lot of rocks to look under for that. But I think the other part, you could probably do some maneuvering around if the committee wants to do that. But anyway, I really appreciate the speaker. I think it's an interesting thing. But as much as anything, I think it focuses on what we're currently doing too. And a real credit to our LSO fiscal staff, and what we're doing is not horrible. And I just think it's a credit to our Wyoming citizen legislature, the last citizen legislature left in the country. It's not horrible, it's pretty good, but if we can keep improving, I think that's great. But appreciate the speaker. This has been a passion of yours for a long time. Appreciate you bringing it to the committee. So we'll keep working on it. Thank you.
Go ahead. Representative Olin.
Thank you, Mr. Chairman. I guess my view on it would be that the priority needs to be this morning's conversation about getting our funds consolidated for the best return. I like the idea of having the information about the cash-based budgeting. I think that's good additional information. I would hate to see appropriations tied to those numbers because I think the current system provides some forward-looking data that's more appropriate for actual budgeting purposes, influenced maybe by having the information on what the cash basis looks like. So I'm really hesitant to put this in to statute form. I think the current system works and provides the options that we need. Thank you.
Mr. Chairman?
Please.
I'm still kind of actually I'm kind of intrigued about maybe not this concept about just establishing a limit so that your budget doesn't exceed the available cash that you had, or that at least that you had. For example, if you simply said, if you looked at the general fund, and Don, would that be, if you're going to do the cash-based budget, would you look at the combination of the general fund and the BRA budget? Look at the combination, you get that average for the last 3 years, and you double that, and you say the next biennium, the general fund budget cannot exceed twice of what was last 3 years. So you've tied it back to the same cash budgeting, and then you probably have to do something like say that in no event can it exceed the Craig forecast as you're looking forward. But anyway, however you would do that, I'm still trying to work through it. But ultimately, when you do that, you don't have to move any cash anywhere. You don't. It doesn't change anything. You're just putting a limit on what you're going to budget to what that cash was, what that revenue was, and the cash that came in. And so it's a little bit of a hybrid, but ultimately it just ends up being a limit. You're putting a limit, and you're saying, and there's a number of states to do that. They're saying we're never going to budget more than X percent of kind of a very similar thing. It's because I had an interesting conversation a couple of years ago when I was the Senate president with the Senate president from Connecticut, and he was bemoaning the volatility of their revenue systems because all the hedge fund managers lived in Connecticut, and so when they had a great year, there was income tax galore from these hedge funds managers that had these $100 million bonuses, and they were paying tax on them, and so they were all happy. They had figured out how they were lopping off the high points on those things and putting them into rainy day funds and budgeting them based on a certain level of their revenues. And really, that's really not much different than we're talking about here in a lot of respects. So with that in mind, I would be interested at maybe the next meeting to look at the bill that came out of the House. Just take a look at it and see what it did. And I'd also like to see I'd like also to know if we took that 3-year average and maybe over the last 2 or 3, because I don't think is that fairly easy to figure. If you look at that over the last 2 or 3 biennia and see what would that be in comparison to the budget that we passed, as far, again, just limited to the general fund BRA side. And just to take this just a step further to see what that might give us something concrete to look at, and right now my head's spinning a little bit, but that at least, Mr. Chairman, Mr. Co-Chairman, that would help me just kind of put some theory to reality and just at least in the rearview mirror and see what that would look like and see how much that would have changed what we had done.
Go ahead.
So to take, piling on to what, or asking a question on what Chairman Perkins' comments were, is if we use that amount and says your budget can't exceed that, What do you do then in the event during the course of that biennium, you have an unforeseen issue that another pandemic, you pick out what it is, then are you, as part of this conversation for our next meeting, how do we address those unforeseens that may be the anomaly to the intended use of those funds according to that structure?
Yeah, and Mr. Chairman, and the answer is, I think it doesn't change. I think you come back in either a special session or the supplemental session, and you make the adjustments in connection with the executive. I don't think it changes, but we'll see. I mean, we'll figure it out.
Further comments? And so just some feedback from my side. I like the concept, number one, of having extra time. To me, that's the nicest thing about what this does in terms of when, and we know, realistically, we're going to be in a declining budget from now to going forward, except for
When we're not.
well, yeah, but volatility wise, oil and gas and coal are all going to start continue their decline. And so that has, I think, a real benefit. And tying our hands to not spend as much money has a real benefit by going through. In fact, our budgets I think are going to start getting smaller. The problem I see is when we start saving and have a bunch of cash on hand, there's going to be a greater propensity to spend it and to go back to where we were. It's kind of like, we created a fund to start pay for our next penitentiary, and that got continually rated until it went away. And like what happened in Alaska, when you have a bunch of money sitting around that people can sit there and look at the money in hand, it tends to get spent. And so good intentions don't lead to good conduct. And so those are concepts that, will this work? I like the idea of having cash on hand. It's one more thing we can do as long as we behave accordingly. But whether we can do that or not is a different question. We could start saving the money now. Just like 1983, if we start putting away $100 million or $150 million a biennium, we can be there in a relatively short amount of time if we leave the money alone and do this in a gradual fashion that I think would be not be onerous on our existing budgets and obligations and the fund of one and that type of thing. So there are ways that we can implement this without I think any pain, and leave that option available and save money over and invest it wisely in the meantime. So that's kind of my off the cuff thoughts on the suggestion.
Mr. Chairman.
Go ahead.
Yeah, just to pick up where you left off, I've always felt that way a little bit about the LSRA is I don't think past legislators that created that account established a clear policy of what the intent was and what they expected as far as potential use of those funds. So I think if we go down this road and we look at trying to save something, a clear definitive policy statement of why we're doing this and what it's for and what our intentions are, I think will help future legislators understand this decision. We've had a lot of debates in my time in the Senate as to what the intent of the LSRA was and how long it was supposed to last and what the burn rate should be. We have no guidance from our predecessors on that. So I think if we go down there, clear policy statements, probably maybe even codified in statutes would be very helpful if this thing's going to hit the finish line.
Okay. So any other directives?
Okay, are we at that point, directives?
Yep.
Mr. Chairman?
Please.
Okay, Mr. Chairman, I think you've already done this earlier. I just want to double check, but based on page 4 of this handout, I think we've agreed then it was asked to do all these yellow funds, and basically our staff, how the size of the reserve account, work with the chief investment officer, is it 5, 6, 7 years? You guys decide and bring it back to us and kind of with the best risk return piece on that. And so all those yellow ones, so we can get those reserve accounts filled up. That was, I was coming into my head today, I wrote this yesterday on the thing, was 4-year profile, but I heard the CIO say 5, heard
5 to 7.
RVK 7. So I'll leave it up. You guys study the risk profile on it. That's one, Mr. Chairman. And then, so I lose my train of thought. So, okay, I think understanding a little more on this accounting piece, that's a separate issue, but I think if we can figure that out, and is there going to be an appropriation for this? Do we need to appropriate? I know we already got all this money. Your committee's done all this with treasurer's office, but how this accounting piece will work in that. I think they got commingled and kind of confused a little bit today. The other thing I'd like to know about are these number of funds. We heard about the 15 funds, and or a little history on where that all came from, and is it SLIB stuff? Is it legislative? And then finally, Mr. Chairman, are there any problems that need fixed in these reserve accounts, particularly timing type things? Are there problems, little glitches we should, a few years ago, we fixed that higher education endowment one because it didn't have a big enough reserve account, and we fixed it. That thing's working perfect now. I think about the Hathaway timing of when they have to pay scholarships to when they get their money. We had that, I think, in an education committee bill last year, didn't make it, but I think this committee would be a good one to make sure, as Matt Sackett said, it's not right hand, left pocket of this money all the time, and it creates confusion and makes it look like the Hathaway doesn't have enough money, which it keeps growing at 700 million now. And so I just think if there's other problems out there we don't know about, bring them to us so we can try to solve them in the session and get all this stuff, as you said, Director Richards, improved, right, as we keep improving this process. So if there's stuff out there, bring it to us so we can fix it. Thank you, Mr. Chairman.
Okay, and the other issue that we've got, Mr. Vice Chair, is that for the working group, it looks like the week of August 8th. Is that right? The week of August 8th. If you look at your calendar and tell me what day of that week works for you, we'll set up another working group meeting. I'm really available, I think, about any time that week, so when I'm not going door to door.
You're doing that too.
Okay, any other business for the day? Yeah, the one for this committee. Yep, go ahead, Ian.
Quick question. So what is our direction with regard to this discussion about cash-based budgeting? I mean, there was quite a bit of discussion. I know Chairman Perkins discussed bringing back up the prior bill and answering those individual questions. Is the content of that discussion what you want then?
I think it would be useful to walk through the bill so people understand more than just the conceptual concepts that we talked about today.
I'm not anticipating offering it. I just kind of want to know and see what that process was, and then just have this historical look back just to see how that would compare, what it would look like if we had done something like that the last couple biennia.
Okay. Anything else?
Mr. Chairman.
Senator Guru.
Thank you. Thank you. Just a quick point. I agree with a lot of the stuff that's been said here. I think the former speaker encapsulated a lot of what I was thinking, and actually the vice president too, about the discussion this morning. I'd rather throw in all those different funds, and then we can pare back if we need to. Same thing with the cash-based budgeting. Take a look at that old bill. That's great. But one other thing I wanted to bring up, and it's kind of important to me. I don't know if it's important to anyone else, but it's about the timeliness in which we get our reports. All the stuff that we got from the treasurer's office, pretty much we got on Friday afternoon. And a lot of those reports, as I read them on Saturday morning, got up early and started reading them. That stuff is a couple of years old. I don't see why we couldn't have gotten that a little earlier. But the bottom line is, it just really, as someone who's serving on 10 different committees right now, it's a little bit tough to, shoehorn all that studying in to get ready for these meetings when you have such a short time to do it. So I'd just like to ask, if possible, I know it's tough, everybody's busy, but if we could get that stuff in a little more timely fashion, I think that would be helpful. I think it would help the committee and help us crystallize our thoughts a little bit more going into it. So that would be my request, Mr. Chairman. Thank you.
Duly noted. Appreciate your comment. Unfortunately, the people that you need to talk to have already left the room. So. Okay, anything else? Okay, so our next meeting for CapFin is now set for,
Mr. Chairman, I think that would be appropriate to mention is that I believe it's the committee's decision to cancel its meeting that was originally scheduled for August 31st, correct?
right, so we are not going to meet on August 31st. So our next meeting, I think, is September 28th and 29th, is that correct?
Mr. Chairman, that is correct, 28th and 29th. And my understanding is that meeting will then be in Cheyenne. Is that correct?
In Cheyenne. No, the rooms up at the Brooks Lake Lodge were $560 a night. Well, we're at JAC's in Casper on the 12th. Okay,